Here's where I want to start, though. You said yesterday that in the midst of all this cyclone uncertainty, all the impact, you said that the discussions were focused mainly on 50 basis points for the hike or 75. What would it take to put 75 basis point rate hike back in the discussion, back on the table?
It would take a significant upside inflation shock from where we are. So, we are back at 4.75% for our official cash rate. We're still projecting the OCR to be around 5.5% by mid next year in coming quarters. We're comfortable with that. The economy has been unfolding broadly as expected since our November statement. So we would need a significant surprise.
Well, you've talked about the fact that the cyclone, the impact that you can look through, you have to look through like temporary spikes in prices. But there does seem there's a risk that some of those temporary spikes could become more permanent. At the very least, would that mean that you may have to keep rates higher for longer?
That is correct. As always, there are upside and downside risks in any forecast. And the cyclone, while in the near term we expect output to be disrupted, it definitely will be disrupted, and some price pressures. Over the medium term, in our projections, we're looking at about a 1% addition to GDP. So that's over coming years. Now, that is well manageable within the current monetary settings, but if inflation expectations continue, if core inflation is more persistent, then tighter for longer is certainly an outcome. So we saw early signs of pricing starting to ease, demand coming back, but this additional demand because of the cyclone will continue to challenge the economy.
Well, I'm also wondering about wages, and we're wondering about the labor market, because we can assume the recovery's already started, cleaning up in the North Island area, and there's going to be rebuilding infrastructure, and that's going to, I assume, start as quick as it can, and it's going to last for some time. Now, you already have a tight labor market. You already have wages starting to just barely now to run ahead of inflation. What if you have maybe the beginning of a little wage price spiral that could turn into something more full-blown?
Yeah, you're putting your finger on a core upside risk here. Labour is the most significant constraint on economic activity in the country. As you say, nominal wage pressures are now rising, which is what we would expect to see. In the particular area, you never know if it is if you could call it a silver lining. The construction sector is projected to slow significantly through the remainder of this calendar year. Well, obviously, this rebuild going on in areas that have been most impacted will need those resources. So there is an opportunity to shift resources across from the traditional building sites into the rebuilding of impacted areas. So that's one part. The other side, of course, is net immigration is back. Our international borders are open. We've got 20,000 plus people coming back into the country, which is going back to business as usual. So there's a supply increase and also a redistribution of economic activity that will happen. The build also, it doesn't all happen immediately. It's going to be spread over a few years. So that also assists with regards to the concerns for inflation and monetary policy.
Governor, when you take a look at the global landscape, with all of the uncertainty, 1 year on, the war continues in Ukraine, China's recovery is on foot and the reopening, there's a lot of question marks over how it plays out. Are you confident that central banks globally will be able to tame inflation? Do you envision returning to a period of subdued price pressures, or do you think the outlook is a lot more volatile?
I don't think the outlook is any more volatile. We always like to, every time we look ahead, we think it's more uncertain than usual. Yes, there are challenges everywhere, but some of the risks you just mentioned are actually downside on inflation pressures. the global economy struggling, demand falling behind the ability to supply, inflation pressures coming out of the economy, global economy, that will help significantly New Zealand's pricing. We're part of that. So some of the downside risks are actually assisting on the inflation battle. The other part is people too often get confused with relative price shifts versus aggregate inflation. Yes, you will see for some goods and services price upward pressures, but they are relative prices. They don't have to lead to generalised inflation. And central banks know their game. We're doing our job. Economies are evolving broadly as anticipated, excluding these ongoing shocks. So, I'm very confident that low and stable inflation will return.
How do you feel about the situation when it comes to the acute labour shortage that was such a big contributor to price pressures? Do you think there are more structural changes that are required to ensure that there's more stability ongoing?
I think within the, globally, labour shortages have been topic du jour. So, we don't feel unique in that front. We have in this country been highly reliant, as in many economies, on external labour coming in, helping us through booms, helping us through seasonal work. With the borders closed, that created, this one-off challenge. I'd like to think normality is resuming in that front. But underlying it all for New Zealand is a productivity challenge. We can't just continue to expect more and more labour to come in. We need to be being more productive. We need to have a deeper capital stock. We are one of the most capital shallow economies in the OECD. We need to invest more. We need to do the same thing better. We need to do better things.
Governor, here in the U.S., we are seeing inflation moderating perhaps a little bit faster than it is in New Zealand. With hindsight, do you feel you should have been more aggressive in the beginning as the Fed has been? And this time around, if you're telling us that inflation remains elevated, why did you slow the pace of tightening?
So on the first one, no, we've been incredibly aggressive with our tightening. We've started from 0.25, we're at 4.75. We were first in the world by a couple of quarters, and we kept going quickly. So I don't think being any faster would have made much difference to what we're looking at. The difference between US CPI and our country is more around just idiosyncratic factors like proportion of energy prices, seasonal food prices, so it's all at the margin, the differences between the CPI. When you strip it out and look at core inflation across the OECD, most countries are within 1% of each other at the moment. The core inflation is persistent. We have persistence here in New Zealand as they do in the US. So, we've got work to do. 50 versus 75, etc. We were in a hurry to get north of neutral, to be into a restrictive position. We are now north of neutral. That gives us time to consider smaller steps and to, watch and observe the data and see how things are evolving. And of course, in recent weeks, we've been hit with an upward price pressure, a devastating cyclone. So, we'll just have to work through that.
Do you expect the recovery to be a bit faster than you originally predicted, given, of course, the economic activity in New Zealand right now?
In terms of, I'd like to see the slowdown first before I start worrying about the pace of the recovery. So domestic demand has been very strong. We're running, right up to the end of last year. We're still very strong GDP. We're forecasting something basically zero growth over this calendar year. And we do need to see that. We need to see demand below supply. In terms of how economies pick up, yes, I always think actual outcomes tend to be much quicker than smooth posted forecasts.
I want to get a couple more in here if I can, Governor Orr. First of all, unemployment bottom at 3.2% in this cycle, ticked up to 3.3, it's at 3.4, but even with 400 basis points of hikes on your part, still stubbornly slow to rise. What does this mean? If it doesn't rise, what does it mean for your peak inflation and peak OCR forecast?
Yes, well, we certainly don't target unemployment. We're here to contribute to maximum sustainable employment. So, in one sense, we've been very, very pleased with the robustness of spending, the robustness of employment, and the fact that households have income growth. It's a wonderful situation. Our challenge will be around price setting behaviour and wage expectations. And so we've got a very strong message out to people: do not expect inflation to remain where it is. Focus on the 1 to 3 in a year ahead's time. With that, if demand slows, employment growth will slow, wage expectations will slow. But I would hope that we get through this slowdown still with a very, very robust labour market.
Does that mean a 25 basis point rate hike is probably not on the table at this point?
Look, all options will always be on the table and I say that straight up, when we turn up at the Monetary Policy Committee every 6 weeks, we start from scratch. Where are we at relative to where we expected? How do we see things going? What are the options ahead of us? So, we will have to play the cards that are in front of us. In 6 weeks' time, we'll be more certain about the devastation and the impact and the rebuild from that one, but I'm sure there'll be a new uncertainty there.
I want to ask you one more question then about what you said about neutral. I want to give it a slightly different metric. You said yesterday policy is restrictive now, it's contractionary. A lot of people say, wait a minute, you have to have your key rate, your funds rate, your official cash rate above the rate of inflation. No matter which part of your yield curve you look at, there's still a big gap there. How do you answer that? Because I think some people might say, you may be heading towards contractionary, but you're not there yet.
Yes, no, I would point to something around the near-term estimated neutral interest rate, which is the interest rate which on average makes you not particularly rushing to spend and not rushing to save. You're kind of indifferent. And that rate is certainly a lot lower than a headline CPI inflation rate. And so it's kind of Econ 101. I would suggest they go back and have a look at that.
All right. And one more kind of following on something that we've asked in a different form. Lessons learned. You were one of the most aggressive rate cutters, one of the most aggressive rate hikers. Looking back, what's one of the lessons you take away from this episode we've been through the past 2 or 3 years?
I think the area where we have most consideration, and I'm speaking globally, is the roles between monetary and fiscal policy. Central banks have gone about their business as usual. Fiscal policy entered the cyclical position far more. Was the combination together too much? And what do we know about going forward on how to better coordinate those two events?